There's a pattern that shows up in every major market cycle, and most investors completely miss it until the window is already closed. It's not loud, it doesn't make headlines. It happens quietly while everyone else is distracted by fear, noise, and the next crisis cycling through financial media. Right now, we are sitting inside one of those windows, and the decisions you make over the next 90 days could genuinely shape the next decade of your financial life. In this video, I'm walking you through 7 specific stocks that look compelling at today's levels, backed by real valuation work, real cash flow analysis, and real macro context. Some of these names you already know. 2 of them, most people watching have probably never seriously considered. And one of them might be the single best risk-adjusted opportunity I've looked at all year. Before we go further, if you're serious about building long-term wealth and positioning yourself before the market catches on, make sure to subscribe and turn on notifications. At Stock Pulse Alpha, we break down high-conviction investment opportunities, market trends, and long-term wealth-building strategies designed for investors who think in decades, not days. You don't want to miss what's coming next. The setup nobody on CNBC is framing correctly. Let's get the macro picture straight first, because context here is everything. We're dealing with a market that's been pulled in 3 different directions at the same time. Energy prices remain stubbornly elevated. Interest rate expectations keep shifting every time new inflation data drops. And geopolitical risk is no longer a tail concern, it's baked into the daily price action. That combination creates something specific: indiscriminate selling. When fear takes over, the market stops distinguishing between great businesses and mediocre ones. Everything gets marked down together. And that's exactly the environment where patient investors build positions that compound for years. Here's the part most people miss. The fundamentals of the underlying economy haven't broken. Employment is holding. Corporate earnings are still expanding. Capital expenditure on AI infrastructure is accelerating, not slowing. What's changed is sentiment, and sentiment is always temporary. Now let's get into the names. Stock 1. The payments giant trading at a discount nobody expected. The first company is American Express. I know, not the most exciting opener. But stay with me, because the setup here is genuinely unusual. Amex isn't a payments company in the way Visa or MasterCard are. They own the network and the customer relationship. Their card base skews dramatically toward higher income consumers, people whose spending stays remarkably stable even when the broader economy softens. That's not marketing, that's structural. The stock trades around 7 times forward earnings right now, near the lower end of its historical range. Revenue is projected to grow roughly 9% annually. Earnings growth sits around 12% over the next 5 years. Free cash flow has compounded near 10% annually for a decade. Under a conservative model assuming 0 long-term growth, intrinsic value comes in around $344, already 17% above today's price. Under a modest 2% growth assumption, that jumps to $410. Wall Street consensus sits near $385. Here's the risk worth naming. If consumer credit deteriorates faster than expected, Amex will feel it. Their charge-off rates are something to watch closely over the next 2 quarters. But the brand, the network, the customer base, those aren't things competitors can replicate. This is the kind of pullback long-term holders look back on with regret if they ignored it. Stock 2. The company quietly powering every AI application on Earth. Next up, Taiwan Semiconductor Manufacturing. TSMC has actually held up well this year, so why does it belong on this list? Because the entire AI economy, every NVIDIA chip, every Apple processor, every advanced AMD product, runs through TSMC fabrication. There is no credible alternative at the leading edge of semiconductor manufacturing. None. Revenue is forecast to grow 31% annually, well above their 5-year historical rate of 19%. Earnings growth tracks at roughly 30%. The PEG ratio sits around 0.82 compared to a sector average of 1.35, meaning on a growth-adjusted basis you're getting a 39% discount. The real risk here isn't fundamental, it's geopolitical. Taiwan-related tensions could create volatility at any time, and you have to be prepared to hold through that. Under a moderate 20% growth scenario, intrinsic value implies roughly 19% upside. Analyst consensus targets near $425. If volatility pushes this lower over the coming weeks, history is very clear about what happens to investors who buy quality at reasonable prices. If you're finding value in this breakdown so far, take 2 seconds and hit that like button. It actually matters for getting this content in front of more serious investors. Stock 3, the ad platform that just became an AI company. Stock number 3 is Meta Platforms, and the numbers here are more interesting than the price action suggests. The stock has barely moved this year, which is what's hiding the opportunity. Forward earnings multiple sits near 21.6, slightly below the 5-year average of 22.8. Meanwhile, growth has been accelerating, not slowing. Revenue is forecast to expand 22% annually, above the historical rate of 17%. EPS growth projects at 21%. The driver isn't social media engagement anymore. It's AI directly embedded in the advertising platform. Better targeting, better measurement, higher returns for advertisers, which means higher willingness to spend. Under a moderate growth scenario, intrinsic value lands near $743, implying 17% upside. Under a stronger free cash flow growth case, it stretches toward $854, 34% upside. Wall Street sees roughly 26%. The real concern with Meta is CapEx. They're spending enormous amounts on AI infrastructure, and investors will lose patience if returns on that spending aren't visible within 18 months. Drop a comment below. Is Meta already in your portfolio, or are you waiting for a deeper pullback? Stock 4. The most mispriced name on this entire list. Stock 4 is Broadcom, and this might be the most compelling valuation setup of the 7. After the most recent earnings report, the forward earnings multiple actually compressed from above 30 down to roughly 25. That's rare. Usually strong earnings expand the multiple. Here, the market is essentially refusing to reprice the business despite the fundamental acceleration. Revenue growth is now projected at 43% annually versus a 5-year historical rate of 18%. EPS growth tracks at 40% versus 18% historically. The combination of custom AI chip dominance, networking infrastructure leadership, and full integration of their enterprise software acquisition is producing numbers that look nothing like the old Broadcom. The PG ratio sits at roughly 0.74, well below the historical average of 1.4. That's a 47% growth adjusted discount. Under a moderate growth assumption, intrinsic value implies 46% upside. Wall Street consensus implies 39%. The margin of safety using midpoint estimates sits near 32%. When fundamentals are accelerating and valuation is compressing in opposite directions, that's the textbook setup. This is the one I'd flag hardest on the list. Stock 5. A generational compounder at a rare entry point. Stock 5 is Visa, and this one matters because Visa almost never gives you a real entry. The stock is down meaningfully this year and trading near its 52-week lows. Forward earnings, multiple sits around 24, below the 5-year average of 27. Pull up a 10-year chart and look at how rare it is to find Visa at these levels. You can count the instances on one hand. Revenue grows around 11% annually. EPS growth projects at 13%. Free cash flow has compounded near 18% annually over the past decade. A reverse DCF on today's price suggests the market is pricing in only about 8% long-term growth, well below what this business has consistently delivered. Under a moderate scenario, intrinsic value implies roughly 33% upside. Wall Street consensus sits near 28%. The risk to acknowledge, regulatory pressure on interchange fees is real, and it's not going away. But Visa has navigated regulatory cycles for decades, and the network effect underneath the business doesn't bend easily. If you're building a portfolio you actually want to hold for 20 years, this is the kind of name that belongs at the foundation. Stock 6, the AI trade most investors already wrote off. Stock 6 is NVIDIA, and the valuation picture has shifted in a way that deserves a closer look than most are giving it. The company now trades at roughly 23 times forward earnings, compared to a historical average closer to 38. That's massive multiple compression for a business still growing at extraordinary speed. Revenue is projected to expand 53% annually. EPS growth tracks at 33%. The PE ratio sits near 0.67, 51% cheaper than the broader sector, and 57% cheaper than NVIDIA's own 5-year average. Free cash flow has compounded at 86% annually over the past 5 years. Read that number again. Under a moderate growth assumption, intrinsic value implies 44% upside. Wall Street consensus targets imply roughly 50%. The narrative concern is real. How long can hyperscaler AI capex continue at this pace? That's the honest risk. But NVIDIA isn't riding a trend that's about to pass. They're building foundational infrastructure for an economy that hasn't even finished its first chapter. Demand is still accelerating, not slowing. Stock 7, the high-growth wildcard hiding in plain sight. The final stock is New Holdings, and this one brings a completely different growth profile to the table. New is a digital financial services company built primarily for Latin American markets, regions where traditional banking infrastructure has historically been thin and huge portions of the population have lacked access to basic financial products. That gap is the opportunity. Revenue is forecast to grow 31% annually. EPS growth projects at 40%, well above the sector average of 12%. The PEG ratio sits near 0.56. Intrinsic value models come in around $23 to $24 per share, implying roughly a 40% margin of safety. Wall Street consensus implies upside near 43%. Now the honest part. New carries more volatility than anything else on this list. Currency risk, regulatory risk, emerging market sentiment, all real. This is not a foundation position. It's a calibrated growth allocation for investors with longer horizons and appropriate risk tolerance. But the runway here is genuinely massive, and the unit economics keep improving every quarter. How I'd actually prioritize these. If I had to rank these 7 by conviction at today's prices, Tier 1, AI infrastructure, Broadcom, NVIDIA, TSMC, highest growth trajectories, strongest long-term upside. Tier 2, dominant platforms, Meta and Visa, world-class businesses, network effects, valuations pulled back from historical norms. Tier 3, stability, American Express, lower excitement, higher reliability, consistent compounding through cycles. On its own, New Holdings, the emerging market growth play for investors who can stomach volatility. This isn't a buy everything tomorrow list. This is a watch list with current conviction levels, your situation, your time horizon, your existing portfolio. All of that matters. Always do your own homework before putting capital to work. The part that actually matters. Here's what separates investors who build real wealth from investors who just watch it happen on someone else's screen. Volatility is psychologically designed to feel unbearable. Every instinct in your body when markets are falling pushes you toward selling, toward making the discomfort stop. The investors who compound wealth over decades aren't the ones who predict short-term moves best. They're the ones who understand quality businesses, recognize when fear has pushed prices below fair value, and stay patient through the noise. Price is what you pay. Value is what you get. Those two numbers diverge most dramatically in moments exactly like this one. Before you close this video, do 3 things. First, hit that like button. It genuinely helps Stock Pulse Alpha reach more serious investors. Second, subscribe to Stock Pulse Alpha and turn on notifications because the next market breakdown is coming sooner than you think. Third, leave a comment telling me which of these 7 stocks you're most interested in or which one is already in your portfolio. I read every single comment. Stay focused. Stay disciplined. The opportunities that markets create during moments of peak fear don't stay open indefinitely, and the investors who prepare now are the ones who will look back at this period as one of the best buying windows of the decade. See you in the next one.